Welcome to Objective 3 in Unit 4 of Accounting 3310, Self-Constructed Assets. This is a special case of long-term assets. When a company builds its own facilities and equipments, generally accepted accounting principles provide guidance on how to record its value as long-term assets so that there's some comparability between self-created assets and purchased assets. What's unique about self-constructed assets? The objective here is that students will be able to understand valuation for self-constructed assets. When a company builds or manufactures or develops a productive asset, then costs are accumulated similar to inventory valuation. The raw materials, the labor, and an allocation of overhead are all part of the value of that asset. Overhead can be assigned in several different ways. It could be that the variable overhead is assigned to that self-constructed asset. That is, those additions to utilities or those additions to salaries above and beyond what the company otherwise would have had, that may be included as overhead. Or a company may look at it more broadly and assign both a portion of the variable and of the fixed overhead to those self-constructed assets. Both are acceptable. In addition, there's an item that is unusual for inclusion in assets, and that's an allocation of interest. A purchased asset includes the raw materials, direct labor, and overhead of the seller's manufacturing process, plus some markup in order to give the seller a profit. When a self-constructed asset is recorded, the allocation of overhead represents similar costs and would result in an understated asset if those overhead costs weren't included. However, there's a danger that the allocation could overstate the value of a self-constructed asset since there's no market mechanism to constrain costs. That is, the company could take an extraordinary amount of time and attention on this self-constructed asset such that the labor costs are enormous, but when added up with the labor costs, the raw material costs, and overhead, it may be that that self-constructed asset is overvalued way beyond what its fair value would be. When that happens, asset impairment becomes relevant, which we will be talking about in this unit. Asset impairment would be applied to self-constructed assets the same way as they're applied to any other asset, and that's what may prevent assets from being recorded at more than fair value. Now, let's also think specifically about what's relevant about interest to the value of an asset. The utility industry had an industry practice of including in the cost of self-constructed plants the amount paid in interest on bonds issued to fund the plant construction, interpreting interest to be a direct cost. That is, the utility industry would not have issued the bonds to build the plant except for the construction of the plant, and often in these cases the bonds could only be used for plant construction. Utility bonds are repaid by the earnings of the plant, so the interest during construction had to be covered by the cash flows from the plant before the plant actually operated. In addition, any entity investing in such a fixed asset would have had to cover its cost of capital, so plants were expected to have a fair value that exceeded raw material costs, direct labor, overhead, and that interest during construction. When the practice was taken up by other companies to include interest in their self-constructed assets, the Financial Accounting Standards Board stepped in to standardize the method of allocating interest during construction for the cost of self-constructed fixed assets and custom-constructed inventory. However, generally accepted accounting principles allows many alternatives in the treatment of interest, and one common implementation will be illustrated, although many other slightly varying possibilities are also allowed. When Financial Accounting Standards Board set standards in this area, it actually expanded the practice of allocating interest to self-constructed assets, and this is now actually a requirement rather than simply an option. The general principle for interest allocation to assets is the following. A company allocates avoidable interest to the value of a self-constructed asset based on the construction expenditures for that asset. The expenditures are counted from the time of their payment through to the completion of the construction of the asset. Note that interest capitalization is limited to actual interest expense for the period. When allocating interest, one major question is what interest rate ought to be used. There are several alternatives for this. One possibility is to use the interest rate on specific debt borrowed for construction. This is commonly done if that construction loan is going to cover all of the costs of construction, but it's not a reasonable choice if the expenditures exceed the specific construction debt. That is, the company may have borrowings completed in the past that are helping to fund this construction. Another alternative is to use the average interest rate on corporate debt. This means that one would be taking into account all of the borrowings the company had and the overall interest rate of the company. These aren't the only two alternatives, but they give us a good idea of what some of the choices are. Let's take an example of a company that has several different sorts of debt outstanding on which it's paying interest. It has a 5% note payable outstanding for $100,000. It has an 8% bond payable outstanding for $500,000, and then it has a 4% short-term note for construction that borrowed just an incremental amount to help to cover these construction costs. What interest rate should be used? The interest rate on specific construction debt is 4%, so that's a possibility. Another possibility is to average the interest rates on the three debts together. To average them, one would not just add up the three interest rates and divide by 3, because the amount of interest is different on each of the debts. So if we look at the note payable, it's for $100,000, but the bond payable is a higher interest rate and it's 5 times as much borrowings. The short-term note for construction is a very low interest rate, but it's only on $50,000. So we want a weighted average interest rate that takes into account the interest rate per dollar borrowed. The way to do this is to have as the numerator in calculating our interest rate all of the interest paid on all of the debt, and as a denominator all of the principal, all of the amounts borrowed. Using that, the average interest rate on this debt is 7.23%, much closer to that high interest rate of 8%, because that, in fact, is the largest of the borrowings. So you can see on this chart, this company would have a choice of two very different interest rates to use for allocating interest from their self-constructed asset. Here's the actual calculations. We're calculating the interest first on the note payable, second on the bond, and third on the construction note, and dividing it by the total principal. Now, we can calculate interest using either one of these. Let's take the next piece of information we need for calculating interest. What do we use as the principal, or the amount that's going to stand in for principal in allocating this interest? First of all, expenditures count only from the time that construction has begun. if we have expenditures before construction, they're going to start to count only when construction begins. The construction period ends when the project is virtually complete. That's a little bit vague, but in many construction projects, there's a final walkthrough that may identify we need a doorknob here and we forgot to paint the baseboard. So, for example, speculative houses may be virtually complete without appliances that'll be added only at move-in. So we're going to finish allocating interest, not holding this time period open for the last doorknob, but when it's virtually complete. Interest accrues from the time of the expenditure through to the end of construction. So here we've identified some expenditures on a project and have identified that only during that period that's highlighted in blue is interest accruing. Avoidable interest can be calculated by summing the interest on each expenditure from the date incurred, or the beginning of construction if later, to the end of construction. Let's go ahead and calculate interest from an example. Let's say construction begins on January 2nd, 2005 and ends on June 30th, 2005. The construction expenditures are the following. On February 1st, $20,000. On March 1st, $15,000. On April 1st, $30,000. And on June 30th, $10,000. Now, looking at those amounts, let's go ahead and project ahead what the period of time is we're going to calculate interest. That $20,000 that is spent on February 1st is outstanding for February, March, April, May, and June for 5 months. So there's 5 months interest on that $20,000 that'll be calculated. The next one in March is spent March 1st, so that $15,000 is outstanding for March, April, May, and June, only 4 months. The April 1st amount that's paid is outstanding for April, May, and June, just 3 months. And the expenditure that's on the day construction ends is outstanding for 0 months, because there's no time during the construction period in which that expenditure is outstanding to accumulate interest. Here's the calculations and a picture that match up with these expenditures. So the $20,000 using that average interest rate at 7.23% for 5/12 of a year, 5 months. The $15,000 multiplied by the average interest rate times 4/12 or 4 months out of the year. The $30,000 is multiplied by the average interest rate times 3/12. Adding up those three figures, we get $1,506 of interest that is allocated. Here are some tips. When calculating interest, remember that the scale of the interest rate and the scale of the term must match. If annual interest rates are quoted, then we've got to adjust the term to the portion of the year as illustrated here. We had an annual interest rate of the 7.23%. So when we had interest to calculate over 5 months, we adjusted 5 months to 5/12 of a year. If monthly interest rates are used, then the term can be expressed in months. Second, notice that we did not include that final expenditure. Expenditures at the end of the construction period don't affect avoidable interest because the time period during construction is 0. After the avoidable interest is calculated, there's one more check. It must be compared to actual interest during the period. If the avoidable interest is more than the actual interest, avoidable interest must be reduced to actual interest and then allocated to the self-constructed asset. Note when avoidable interest is exactly equal to actual interest, then there's no interest expense deducted on the income statement because all of the interest is being used as part of the cost of a long-term asset. Whatever is included as avoidable interest reduces interest expense for the company. These are the financial statement effects. On the income statement, when there are self-constructed assets, interest expense is reduced by the capitalized interest. Thus, the more interest that's allocated to self-constructed assets, the higher net income is. On the balance sheet, capitalized interest increases the value of a long-term asset and is a part of the depreciable base. Thus, the interest does eventually show up on the income statement, but only as a part of the depreciation, the wear and tear on the asset constructed. On the statement of cash flows, capitalized interest has a special place. It is included as a cash outflow for investing, and it's all considered a cash outflow. This means that operating cash outflows for interest equal the total cash outflows for interest minus capitalized interest. The report of cash interest paid is just the cash outflow for interest in the operating segment. Allocating interest on self-constructed assets is very unique in generally accepted accounting principles, because allocating a portion of interest incurred, even if no debt is specifically borrowed for a construction process, is a departure from the usual historic cost accounting. The Financial Accounting Standards Board decided to go ahead with this because money is fungible, so debt provides funding for all of the company projects, including construction, and construction requires funding before the asset's use, making it a direct cost of self-constructed assets. Others object that debt-financed assets and equity-financed assets should not differ in their fair value, so interest doesn't really represent a value added to self-constructed assets. A company that had no interest-bearing debt would end up with a lower value for their self-constructed assets than a company that did have debt financing. However, this objection was not persuasive, and interest is allocated to self-constructed assets. I hope this explains one of the unique features about long-term assets. It involves calculations that you now are very familiar with of interest equals principal times rate times time, and gives you one more opportunity to practice. Thank you.